Hey everyone, and welcome to a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. Let's jump right in because today we're putting on our forensic accountant hats. We're looking at a real-world accounting practice that honestly looks totally normal at first glance. But as you'll see when we peel back the layers of the Indian accounting standards, there's a massive flaw hiding in plain sight. We are untangling the very tricky relationship between financial guarantees and contingent liabilities. It's a classic case of an error hiding right in front of us, and I can't wait to unpack it with you.
Before we look at the evidence, let's lay down a few quick ground rules. For this explainer, our functional and presentation currency is the Indian rupee, meaning any other currency is considered a foreign currency. Our reporting period is the standard April 1 to March 31st, and just a quick reminder, the views I'm sharing here are purely my personal takes. They aren't binding on anyone, so definitely make sure you seek out an expert before taking or holding off on any action based on what we discussed today.
So, where did we actually find today's case? Well, this observation comes straight from the published Ind AS financial statements of a listed company, which were downloaded and independently reviewed suo motu by Gap Advisors. We also featured this exact case in the 224th edition of the Gap Advisors Task Weekly newsletter. That newsletter is authored by CA Manish C. Iyer, director at Gap Advisors, and published right on LinkedIn. Actually, there are over 230 editions out there right now, so if you're on LinkedIn, you should absolutely go subscribe to the newsletter for free. Okay, here's our game plan for today. We'll start with the real-world disclosure, move into defining financial guarantees, then look at the insurance exemption illusion, followed by why the exemption fails, and we'll wrap up with the final verdict. Section 1. The real-world disclosure. Let's head straight to the scene of the crime, so to speak, and see what this company actually reported. Let's look at the item labeled Roman numeral 2, guarantee. The company explicitly says they have given a guarantee on behalf of their subsidiaries to cover their loan obligations. And we're talking about massive outstanding balances here, literally hundreds of crores. But look closely. They've grouped this huge obligation under the broad headings of contingent liabilities and unrecognized items. They're basically telling us, yeah, we guarantee these loans, but we don't think we need to actually recognize a liability on the balance sheet for them. Section 2. Defining financial guarantees. Let's crack open the Ind AS 109 rulebook and see if their approach actually holds any water. Take a look at this quote from Appendix A of Ind AS 109. It defines a financial guarantee as a contract requiring the issuer to make specified payments to reimburse the holder for a loss it incurs because a specified debtor fails to make payment when due. Let's map that to our case. Our company is the issuer, the subsidiary is the specified debtor, and the bank is the holder. If the subsidiary defaults, the company pays the bank. Guys, this is a perfect textbook match. There's zero doubt that this guarantee is a financial guarantee contract under Ind AS 109. Section 3. The insurance exemption illusion. So, if this is clearly an Ind AS 109 financial guarantee, which normally means it should be recognized at fair value, how did they justify just disclosing it as a contingent liability? You kind of have to wonder, right? Were they leaning on some hidden exception in the standards? Like, did they treat this guarantee as an insurance contract internally to bypass recognizing the liability? Let's explore that possibility. Paragraph B 2.5 of Ind AS 109 actually deals with this exact scenario. It says if an issuer has previously asserted explicitly that they treat these contracts as insurance contracts and they've used insurance accounting for them, they can elect to apply the insurance standard, like Ind AS 104 or 117, instead of Ind AS 109. So theoretically, going the insurance route might let a company keep treating it as a disclosed contingent liability rather than putting it on the balance sheet. Which brings us to Section 4, why the exemption fails. Because, spoiler alert, this defense completely falls apart when you look at the timeline. Let me show you why. This chronological sequence is the ultimate trap for this company's logic. Paragraph B 2.6 of Ind AS 109 states that your explicit assertion about using insurance accounting has to be found in your historical communications or past financial statements. But here is the kicker. Under the previous Indian GAAP, before Ind AS, there literally was no accounting standard for insurance contracts. So when any non-insurance Indian company transitioned to Ind AS, it was historically impossible for them to have made that required prior assertion. I mean, you can't assert compliance with a standard that didn't even exist. The logic is inescapable here. because making that historical assertion was absolutely impossible under the old Indian cap framework. This specific exemption in Ind AS 109 is completely off the table for non-insurance Indian companies. It's a total dead end. If you aren't an actual insurance company, you have to apply Ind AS 109 to these guarantees. Section 5. The final verdict. We've defined the guarantee, and we've completely shut down the insurance loophole. Now let's look at Ind AS 37, the standard they actually used, to close the book on this. Paragraph 2 of Ind AS 37 is crystal clear. It states, this standard does not apply to financial instruments, including guarantees that are within the scope of Ind AS 109. It literally explicitly scopes out guarantees. You physically cannot use the provision standard for something that belongs in Ind AS 109. By treating these guarantees as contingent liabilities, the company directly violated this very paragraph. So, here is our definitive takeaway. The company absolutely must recognize and measure these subsidiary loan guarantees as financial liabilities on their balance sheet, initially at fair value under Ind AS 109. Merely throwing them into the notes as an unrecognized contingent liability under Ind AS 37 is a massive accounting error. They are just flat out underreporting their liabilities. Figuring out these standards can feel like walking through a minefield sometimes, right? That's why having the right resources is absolutely crucial. I highly encourage you to go register for free at gapadvisors.com. Their issue repository hosts over 4,500 distinct issues and detailed responses on Indian accounting standards and Indian GAAP. Once you register, you can submit your own issues and get a detailed response delivered straight to your inbox. This is incredibly useful, especially for auditors who need bulletproof documentation on how they addressed complex Ind AS applications. And hey, here's a pro tip. Get your financial statements reviewed by the experts at Gap Advisors before you sign them. Just email your near publishing PDF to insto@gapadvisors.com. Don't let an error like the one we saw today slip past you. Thanks so much for hanging out with me today. If you found this breakdown helpful, please hit the like button, drop a comment with your thoughts, and make sure you're subscribed to the Gap Advisors Ind AS Clinic channel if you aren't already. We'd also love it if you shared this explainer with your contacts, your colleagues, your audit and finance teams, and especially any students pursuing their CA course so we can keep spreading this knowledge. And if you want to go even deeper on today's observation, be sure to connect to the Gap Advisors Ind AS Clinic podcast over on Spotify, Amazon, or YouTube. I'm going to leave you with this one provocative thought to take back to your desk today. Are your subsidiary guarantees hiding in plain sight as contingent liabilities? Go check your files, check your client's work, and don't let an unrecognized liability catch you off guard. Keep learning, keep questioning, and I'll catch you in the next explainer.